Ever wondered what makes a stock a profitable investment? Well, we're about to embark on a journey of financial insight to answer that very question. Today, we're discussing the insightful book, Common Stocks and Uncommon Profits, penned by none other than Philip Fisher. Philip Fisher, a name synonymous with intelligent investing, is widely regarded as a pioneer in the field of investment philosophy. His strategies and concepts have withstood the test of time and continue to shape the world of investing. This book, Common Stocks and Uncommon Profits, is a testament to his wisdom and expertise. Through this masterpiece, Fisher shares his invaluable insights into understanding the market, identifying potential stock, and making smart investment choices. His advice is not just theoretical, but practical, tested over years of his own experience in the stock market. Prepare to dive into the wisdom of this investing titan and learn how to spot a profitable stock. Let's dive into the heart of the matter. Investing is not a gamble, it's a calculated risk. Chapter 1 of Common Stocks and Uncommon Profits hammers home this very point. Investing, as Philip Fisher suggests, isn't about throwing your money into the market and hoping for the best. It's about making informed decisions based on thorough research and understanding of the business. You wouldn't buy a car without checking under the hood, would you? The same principle applies to investing. To make a sound investment, you must first get to know the company you're investing in. This means understanding its business model, its products or services, its market and its competition. It's about digging deep, going beyond the surface-level facts and figures. But that's not all. Fisher insists on the importance of considering the long-term prospects of a company. The world of investing isn't for the short-sighted. It's for those who can look into the future and see the potential of a company. It's about investing in a company's vision, its ability to innovate, and its resilience in the face of challenges. Remember, investing isn't about quick wins. It's about making strategic decisions that yield long-term benefits. It's about patience, persistence, and a good deal of homework. So, the next time you're tempted to make a hasty investment decision, remember Fisher's words. Smart investing begins with a thorough understanding of the business you're investing in. Investing has its rules, and breaking them can cost you. One cannot stress this enough. The second chapter of the book, Common Stocks and Uncommon Profits by Philip Fisher, highlights 5 mistakes that investors should steer clear of. Firstly, don't be hasty. Investing isn't a sprint, it's a marathon. Patience is the key. Don't rush into investments without adequate research and understanding. Secondly, don't follow the crowd. Herd mentality can lead to disastrous investment decisions. Independent thinking is crucial when it comes to investing. The third don't is to avoid over-diversifying. While diversification is indeed a risk mitigation strategy, too much of it can dilute potential returns. Fourthly, don't be swayed by short-term market fluctuations. Investing is about long-term growth. Short-term market volatility is a part and parcel of the investment journey. Don't let it derail your long-term investment strategy. Lastly, don't ignore the qualitative aspects of a company. Financials and numbers are important, but they are not the whole story. The management's competence, the company's competitive advantage, and its corporate governance are equally important. These 5 don'ts for investors, when followed diligently, can help you avoid common pitfalls. Remember, investing is as much about avoiding mistakes as it is about making the right decisions. Avoiding these common pitfalls can make the difference between success and failure in investing. Not all stocks are created equal. Indeed, Philip Fisher taught us that there are 15 key points to look out for when choosing a common stock to invest in. Let's dive into these points. Firstly, look for companies that have services or products with the potential for significant growth. The market isn't static, and neither should your investments be. Secondly, aim for companies that are committed to constant research and innovation. The ones that lead the pack are those that keep evolving. Thirdly, look for companies with an above-average sales organization. Sales are the lifeblood of any company, and a strong sales team is a good indicator of success. Fourthly, consider companies with a worthwhile profit margin. Remember, it's not just about making sales, but making profitable sales. Fifthly, don't overlook the importance of a good management team. They're the ones steering the ship after all. The sixth point is to invest in companies with good cost analysis and accounting controls. This shows that they're keeping a close eye on their finances. Seventhly, look for companies that have strong policies of maintaining or increasing profit margins. This shows a commitment to constant improvement. Eighthly, consider companies that understand the value of remaining a leader in their industry. Staying ahead of the competition is crucial. For the ninth point, consider companies that have depth to their management. This means they're not overly reliant on one or two key people. Tenthly, look for companies that have good cost control. This shows they're good at managing their resources. On the 11th point, consider companies with unique products or services. These stand out in the marketplace. 12thly, look for companies that are open to change. This shows they're adaptable and ready to meet new challenges. The 13th point is to look for companies with a strong focus on high-value products or services. This shows they're committed to quality. 14thly, consider companies that have a strong balance sheet. This shows they're financially healthy. Lastly, the 15th point is to look for companies that don't dilute their existing shareholders. This shows they value their investors. Choosing the right stock is a complex process, but these 15 points provide a solid foundation. Knowing when to hold them and when to fold them is crucial in the stock market. As we delve into the fourth chapter of Philip Fisher's masterpiece, Common Stocks and Uncommon Profits, we realize that the art of buying and selling shares is not as straightforward as it seems. Fisher suggests that it's not about buying at the lowest price or selling at the peak. Instead, it's about understanding the intrinsic value of a company and using that as your compass. If a stock is undervalued and the company's fundamentals are strong, that's the right time to buy, regardless of market conditions. On the other hand, selling should not be triggered by short-term price fluctuations. Instead, sell when you realize that the stock's intrinsic value is not as high as you initially thought, or when there's a fundamental change in the company's prospects. Fisher also warns against being swayed by market sentiment or the so-called hot tips. He emphasizes the importance of doing your homework and making an informed decision. It's also worth noting that Fisher does not believe in diversification for its own sake. Instead, he advocates investing in a few companies that you understand well and believe in. In conclusion, as Fisher puts it, the best time to buy is when you have done your research and believe in a company's long-term prospects, and the best time to sell is when the company's fundamentals have changed for the worse. Timing is everything in investing, and knowing when to buy or sell can significantly impact your profits. Success in investing comes with its own set of rules. As we delve into the final chapter of Philip Fisher's insightful book, we uncover the wisdom he shares about the pitfalls successful investors need to avoid. Firstly, resist the temptation to follow the crowd. The market, like a crowd, is often swayed by emotions rather than reason. A successful investor stands apart, making decisions based on their own analysis and understanding. Secondly, avoid the urge to make quick profits. Investing is a long-term game. Patience is key. Remember, Rome wasn't built in a day, and neither is a robust investment portfolio. Thirdly, don't shy away from asking questions. A good investor is a curious investor. The more you know about a company, the better equipped you are to make informed decisions. Fourthly, don't get swayed by market predictions. No one can accurately predict market movements all the time. Instead, focus on the quality of the business you're investing in. Lastly, don't ignore your mistakes. They are valuable lessons, the stepping stones on your path to becoming a successful investor. In conclusion, it's not just about what you do, but also about what you don't do. Investing isn't just about buying the right stocks, it's equally about avoiding the wrong ones. It's about striking a balance between being proactive and being patient. Adhering to these guidelines can help you become a successful investor. So, tread carefully, ask questions, learn from your mistakes, and above all, stay focused on your long-term goals. Investing is not a game of chance, but a game of skill and knowledge. This truth is echoed in every chapter of Philip Fisher's Common Stocks and Uncommon Profits. As we've journeyed through this insightful book, we've discovered that understanding the business you're investing in is vital. It's not about betting on the next big thing, but about making informed decisions based on thorough research and analysis. We've also learned the importance of choosing the right stock. Fisher's 15 points provide a comprehensive checklist to guide us in this selection process. And remember, knowing when to buy or sell is just as crucial. We mustn't be swayed by market trends, but instead rely on our understanding of the business and its intrinsic value. With these insights from Philip Fisher, you're well on your way to becoming a savvy investor. Remember, knowledge is power in the world of investing.